What makes this easy, not easier, what makes this easier than most things is this fact. Let's do it again. Elephant bar, tail bar, 180. These are your big plays. 60+%, 15%, 10%. Now, it would be a little tougher if it was 10%. But the thing that delivers the results for you more than anything else also happens more frequently than anything else. You've got the best of both worlds. You got the best of both worlds. What happens the most is what rewards you the most. Because oftentimes in life, guys, what happens the most is not the best. That's what happens most of the time in life. That what is good happens the less frequently. That what happens most frequently is not good. Well, in this rare scenario, what happens the most frequently is the best for you. That is special because that does not come along very often. There are a small handful of very powerful events, I call them plays, events. And one of those events is the elephant bar. Okay? This is event number 1. It's the elephant bar. Now, you can have a bullish version or a bearish version, but let's draw in the elephant bar. That can be red for bearish. It can be green for bullish, but this is event number 1. Event number 2 can be something like, I'm not going to go over all of these, but this can be a topping tail bar or a bottoming tail bar, right? It's event number 2. Okay. This can also be the reverse. All right. It can be this. Okay. That's 2. And then let's just do 3 here. And you can have something like the bear 180 or the bull 180, right? Everything else is sort of like a regular to minor artillery item. This is your heavy artillery, and then you have your normal artillery. These 3 things are the heavy. All right, so I just want to just briefly touch upon these, but I want to give you statistics associated with this. Elephant bars will represent 60+% of all of your plays. 60+%. It's actually closer to 65, but let's just use 60 right now. 60+% of all of your plays. These will represent 15% of all of your plays. And these will represent 5% of all of your plays. They happen less frequently. Now, look at your heavy artillery and look at where the vast majority of your activity is always going to be when dealing with a power play, when dealing with the heavy artillery plays. It's going to be with your elephant bars. All right? Now, so guys, when I told you, if you're not going to take this long, all right, if you're not going to take that long, then you must wait. If you're going to take anything, you must wait for the number 1 play, the number 1 deliver of profits in a bear market, which is a bear elephant bar. And you get that right here. Boom. Anticipatory entry, 2 lots, stop above the high, first color change, mandatory add, and the rest is history. Okay? When someone tells me, like earlier, one of our traders said, it's not been easy over the last few days, this is the problem. You're not focused on the right thing to play in this market environment, and you must not be willing to bypass what has the lower odds, as good as it is. All right. Now, again, nothing's wrong with taking that long, but I told you I would rather miss this and catch that. MU starts off bullish activity this morning, but in the trap zone, but clearing nonetheless. I've explained to my traders that if you're in a trap zone, as long as it's wide, and especially if it's a clearing event in a wide trap zone, you can take this. I had some traders that actually took this morning. But as I told you, I would rather miss this and wait for, boom, the number one deliverer of flow, of trend, of power, of money in a bear market, the bear elephant bar. All right. This makes this bear elephant bar is extra powerful because it's originating far above its next key moving average below. So there's space, and it's surging from a 200 period moving average above. So any surge from a 200 period moving average, and any time a play has space to the next moving average, it's extra powerful. But this continues to drop all the way back to the low. Very, very powerful. The bear elephant bar. What first part did you miss? The fact that there's a big space between the origin of your play and the 220 period moving average? Is that the part you missed? Space concept. We talk about it all the time. All right. Okay. Now, anticipatory entry. Boom. 2 lots. Stop. First color change. Boom. 1, 2, 3. Done. Cam Cure is saying, well, it's in a trap zone. Yeah, but what trap zones are appropriate to play when they are in what state? Let's help him out a little bit. What trap zones are okay to play in what state? A wide state. All right. So here's your trap zone. And when you have a wide state, playing on either side of the wide state is preferable. So here, the long is on the lower side of a wide state. The bear elephant is on the higher side of a wide state. All right, good. Okay, so very clear. Guys, this is not rocket science. It appears difficult to you because you're bringing the difficulty. The market doesn't have difficulty. You bring difficulty, right? If things are confusing, you're bringing confusion. The market's very simple. It's got 3 movements, up, down, sideways. That's not complex. You bring the complexity. You're making this harder than it has to be. There's two color bars, red and green. There's 2 states, wide and narrow. There's 2 main moving averages, 220. You understand? There's 2 positions, above the Fab 4, below the Fab 4. There's two major trends, up and down. There's 2 plays, long and short. There's 2 results, win-loss. This is a very basic ABC game, but you're overcomplicating it and you're fighting the obvious. This is where all of the complexity and all of the problems come from. You're fighting the obvious. You guys still want to fight me here. I'm not sure I see what you're saying about, oh, on the 5-minute chart. Yes. Yes, you're playing the 5-minute chart. Boom. There is your fat elephant bar, and the combo play is the bear 180. Beautiful. All right. All right, but let's keep going here. Let's keep going. I'm going to show you, well, let's take a look at Uber. All right. Now, Uber had a beautiful bottoming tail bar play off of a narrow state. Beautiful position here. And had a nice little run. Again, this, I can't fault you for taking that play. I cannot fault you. There's nothing technically wrong with that. But the thing that I don't want you to forget is that you are statistically going to have better odds waiting for the number one thing in this market, which is the fat bear elephant bar, which you should be trying to dive into before the bar finishes trading, the anticipatory entry. Entry, stop, first color change, here's 2 lots, here's 1 lot, and the rest is history. All right, but this was a very beautiful move off of that perfect narrow state position, bottoming tail bar. Nothing wrong with that either. But your best odds are going to be on the short side, waiting for the bear elephant bar. Intel. All right, here's the bull elephant bar off the open. Nice run, but boom, your bear elephant bar forms a bear 180. You want to jump into that bar, stop above the event. Your next color change, remember that combination? First entry, boom, stop. Next entry is the first color change, boom, 1, and the rest is history. All right. How is this difficult? Waiting for fat red. How a 12-year-old can easily do this. How is this difficult? It's not. It's only difficult when you're forcing the wrong thing. Cisco, look at this. Here's all the others were after the bull, right? So all the others I showed you, there was an initial bull run. And if you just wanted to simply wait for a bear 180, if and when it developed, you take the bear 180 reversal. But what if you get the bear 180 off? What if you get the bear elephant bar off the open in the right position? Nothing wrong with that. Boom. Stop. First color change. Here's 2 lots. Here's first color change, 1 lot, and the rest is history. So whether the bear elephant bar is under the Fab 4 or under the moving averages or above it, as long as there's space to the very next level of support, if it's above it, they're both takeable. They're both takeable. All right. So your MU is takeable up here. You've got room to the next level of support. You know, your Intel is takeable up there. That's fine. When playing the bear elephant bar, you're going to have the overall flavor of the market in your favor. You're going to have the winds behind your sail. You're going to have the fear element helping you, even if what occurred before it was green. So what I'm going to do right now is, from a chart perspective, I'm going to demonstrate specifically what I mean by the neutral zone, and I'm going to show you some things that will help you ensure that the vast majority of your activity is outside of the neutral zone. So I'm going to use a stock called JD.com. It's the chart here in the upper left-hand corner of my platform, and I'm going to use that chart here today. I'm going to point out this solid red bar. Now, this solid red bar is a fairly violent negative red bar, but that negative red bar is in what I would call positive territory. It is above the key moving average. So below the key moving average, this is the key 200 period moving average, would be negative territory, generally speaking, and above would be positive territory. So we've got a violent negative bar in positive territory, which means that we have a certain degree of conflict. Now, most of your trades you want to take with zero conflict. So you're going to buy strong bars in positive territory, and you're going to short negative strong bars in negative territory. And if you keep the majority of your trades in sync with position, you're going to have a better chance at earning money consistently as a trader. Now, that's not the topic that I want to drill into today. I'm going to assume that some traders would want to go short into this bar because of its size, because of its power, because of its violence, despite the fact that it is in positive territory. So my traders might say, well, I do understand that this stock is in positive territory, so I have position against me, but the power of this bar is very, very, very strong. So I'm going to bet with the power of the bar. And some of them would go into this bar toward the end of the formation of this bar short, okay? Knowing that they're fighting position. So when they're fighting position, I tell them that's okay, but I don't want them to fight position with heavy positions. So they would typically take this play. If they wanted to take this play, they would take it on the light side. But anyway, let's assume that they're betting on the downside by going short into this bar here. Their stop would be above the high of that bar. Now, my traders do utilize, in most cases, what I call a 2-bar stop. So this 1-bar violation of the stop is not enough to get them out of the trade. They need a second bar to actually go higher than the first bar that breaks. So this is not an official stop out, despite the fact that it looks like it did stop out or violate the high. It did not violate the high with a 2-bar stop. But anyway, so let's assume that the trader is short here, betting on a downward move, right, toward this 200 period moving average. Okay, so they get short. They have a mental stop 1 penny above the high of the first bar, their reason, and they get some downward movement. Okay, now let's say their rule for profit taking is 2-bar push. So let's say they get this 1-bar push. There's 1 bar right there. So 1 bar of profitability, but their trading plan demands that they only take profits on a 2-bar push. Okay, so this would be a 2nd bar move in their desired direction. And so according to their trading plan, they don't have a profit on the 1-bar push, even though their platform is going to say that they're profitable. Their platform might say, depending upon the size of this, might say that they're up $150 on this 1-bar push or $200 on this 1-bar push, depending upon the size of their initial position. But just because the platform says that this trade is working and you have $200 at the current moment, the trader should not feel as though they're profitable, because until they get the second push, they don't have a takeable profit according to their trading plan. Now, if their trading plan said that they could take profits on one push, then they do have a takeable profit and they are no longer in neutral territory. But if the rule is two pushes, then I don't want my traders thinking that they have money. They do not have takeable money until they get two pushes, if that is their rule. And staying consistent with your trading plan, whatever rules make up your trading plan, is one of the keys to developing consistent profitability. You can't get consistent gains without applying your method, your template, your techniques consistently. You can't be all over the place, changing on this trade and then flip-flopping on another trade and expect consistent results to come from this wishy-washy, flipping back and forth, changing and tweaking every other trade. You're not going to gain consistency that way. So one of the ways to gain consistency is to create a set of rules that make up your overall trading plan, and to do it without fail over and over and over again. All right. So as this stock fails to give a second push, it fails on the second push. It gives one push. It fails to give a second push. As you can see, what happens is that that one push gets erased by a move up. Now they're back to break even at this point. The platform is not showing any gains or losses at this particular point. As this stock moves up past the initial entry price, now the platform says that the trader is negative. So as the stock is moving up above the initial short point, the platform is demonstrating negative, 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 negative. But I don't want the trader to assume that they are negative. The platform might say that in this case, they're negative $180, $150, whatever the number is. But that's not a loss. That is neutral territory. So neutral territory in the context of this trade is anything below the stop out point and anything above the general area of where a two push move would occur. One push, two push. So this is your neutral zone. Do you understand? And so when a trader responds to the small gyrations of a stock inside of the neutral zone, they actually start to get played by the stock. That they fail to play the stock is actually playing them, swaying them with every gyration, every micro move, every little few ticks to the upside and a few ticks to the downside. They find themselves emotionally reacting to these small movements in the neutral zone. And the neutral zone should be left alone the vast majority of the time. There are exceptions, and I teach my traders what those exceptions are. But for the most part, 85% of the time, you should not be reacting to what a stock does in the neutral zone. And you should not be reacting to your P&L. All right. Your P&L in the neutral zone does go up and down penny by penny, but you can't be moved by the P&L. P&L traders are chronic losers. Plan traders move themselves to consistent profitability. All right. So if we follow this trade out, it ultimately over time did produce a little move to the downside. Nothing to write home about. And we can understand that because the play is a short in positive territory. And that's typically what you get when you fight position. But anyway, let's follow the play out. This trader shorts this bar toward the end of the formation of that bar. And let's say they short 200 shares. Okay. They have a mental stop above the high. They get a 1 bar push where their P&L says that they're profitable, but their rule says that they're supposed to take a profit on 2-bar pushes, and they don't get the 2-bar push. This 2-bar push ultimately disappears, moves up to the upside, and now as this stock moves past their original short entry price, the platform is saying that they're negative, 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 but they're negative in neutral territory. We blip one little blip above the high, but we need 2 bars above the high to actually get stopped out. So the trader's rule does not get them out because there is no 2-bar violation. All right, the stock falls back. Now their negative becomes less negative, less negative, less negative. All right, but they're not responding to that. This is all in the neutral zone. This original entry price is around this here. They're now break even. Their platform says that they have not a loss or a gain. They briefly go into positive territory, but that's not really positive territory. It's still in the neutral zone. Now the stock moves back to break even. Their platform says that they're not positive or negative. As we continue to move up, that platform says you are negative, you are negative, you are negative, but the trader is not going to respond to that. The trader knows that's a lie until they get officially stopped out. They're still in the neutral zone. We fall back to break even. Now the platform says that they're flat. We move back up marginally. Now the platform says that they're marginally negative, but the trader doesn't respond to these gyrations. The trader doesn't respond to these micro movements. The trader is not reactive to what the platform says in the neutral zone. And this is how calm, sure, powerful trading occurs. When a trader understands what moves are meaningful and what moves are not meaningful. You need to understand this concept of neutral zones so that you can be a calm, powerful trader, and you can differentiate between meaningful moves that need and require your action and the little fake moves that don't. And it's the fake moves that play the traders ridiculously over and over and over again, that trick traders over and over and over again who do not understand this. So as this stock moves back to break even at this particular point, the platform says that the trader's flat, not a win, not a loss. And now we move past the entry point. Now the platform is saying you're positive, a little less positive. Now you're more positive, you're more positive, you're more positive, a little bit less positive, a little bit less positive. Now you're more positive, boom. And the trader potentially decides, I'm going to take profits here. All right, and this is based on another item that I teach my traders, that once you break the low of your initial move, you have a right to take profits. Okay? Entry here, profit here. Small gain, took time, but we've already discussed that that's not surprising given the fact that it's a short in positive territory above the 200.